All right, so let's get back into it. Inventory management. So the first in, first out method, just as I explained, it's essentially the most common way in which stock rotation is done in any retail establishment. The first goods that are bought are the first goods that are sold. All right, and it reflects the same physical flow of merchandise called stock rotation. And I use the example of the potential of expiries, especially in groceries, as you see here in slide number 5, where things like milk may have an expiry that would be coming close to based on when you bought it. So you always put that out to the front to get sold. All right. The last in first out method is used where um, it's and you will see here in the slide it's a real tax purpose method of doing inventory costing. Even if it doesn't actually represent the physical flow of units, it's something that is done because you always have price increases. So if you always have price increases, then the last set of goods that you buy would most likely be the more expensive set of goods. And if that is the case, then it's going to be used for your income statement to show that you would have sold a larger amount of money. Um, Therefore, your taxes, your cost of goods sold. Sorry, your cost of goods sold is now an expense that will now determine your net profit. So if your net profit is low based on your expenses being high, then your tax calculations are low. I hope everyone is following me here. Let me repeat it again. If your inventory, if your cost of goods sold is on the higher end of what it can be, then your net profit is going to be smaller. And we all know that taxes are calculated based on profits. So if your net profits are then smaller, then your tax calculation is going to be less. Good? Moving on. And the weighted average cost, as I said, it's all the units that you bought several units at different prices within a particular time period. You have the total amount of units bought and the price that you pay, total price that you paid, and you get an average price. All right, so that's weighted average costing. And we go on to slide number 9, where you can see how the first in, first out cost can affect your. And when you look at the slide, if you look at slide number 9, guys, I'm drawing your attention to slide number 9. Look on the right hand side of that slide, and you would see merchandise. Sorry, you would see what is being called merchandise inventory. That is also called ending inventory. Merchandise inventory is also called ending inventory. And in the blue section just above it, you'll see cost of merchandise sold. That's also called cost of goods sold. On the gray column, which is in the middle of the slide, you see merchandise available for sale. That's cost of goods available for sale. Okay, so just want to get you to understand that merchandise simply means ending inventory, merchandise inventory. Cost of merchandise sold is cost of goods sold. Merchandise available for sale is cost of goods available for sale. Now we're going to use that because that's the more common term. So let's take a look. Let's go through the slide slowly. In January, we bought 1,000 units at $20. January 1st, January 10th, we bought 500 units at 22.50. So we can see we bought it at a higher price. And on January 30th, we bought 600 more units at an even higher price. Now, based on first in, first out, we would have sold out all the 1,000 units we bought in January 1st at $20. So you see, the cost of goods sold is 20,000. Then we sold 300 of the 500 units bought on January 10th. And that 300 multiplied by 2240 gives us 6720. So the cost of goods sold is the 20,000 plus the 6720. At the end of January, we have now a remainder of the units that were bought at the end of January and some that remain from that were bought on the 10th of January. And look at the arrows. Look at the arrows. We have an arrow coming from those bought on the 10th of January that feeds down to your ending inventory. And then we have all 600 units bought on the 30th of January at 2330 to give you 13,980 plus 200 units bought on the 10th of January at 2240 because your ending inventory, those ones sold. So that now is going to give you ending inventory of 18,460. Now, if you go to the other slide, which is last in, first out, we now start off at the bottom of the slide, where all of the units that you bought on January 30th are presumed to be sold first. So immediately, all of the units you bought at that higher price is sold. Then you sold all from the ones bought on January 10th, all of it. So that now goes to your cost of goods sold. And then from the ones that you bought earlier in January 1st, you sold 200 from those, and then you are remaining now with 800 units that are presumed to be from the 1st of January purchase. I know it might sound a little confusing with all the purchase and the words. Look at it slowly, look at it closely, and you now see that you have an ending inventory of $16,000 as compared to an ending inventory with first in, first out of 18,460. All right. So understand and appreciate that using either of these can alter your ending inventory figure and can also alter your cost of goods sold figure. And you can see your ending inventory in last in, first out, or LIFO. LIFO is 16,000, and your ending inventory with FIFO is 18,000. All right, and your cost of goods sold with LIFO is 29,000, and the cost of goods sold with FIFO is 26,000. It might seem as a small amount, $3,000 different, but in large, this is just an example, a small example to give a snapshot of how this can be calculated. All right, and in companies that have large inventory, then you can see where it would make a real huge difference. And next we have the weighted average, which is your total cost of units available for sale and your number of units that were available for sale. So the total cost of units available for sale, which was 45, which is your cost of goods available for sale, 45,180. That didn't change. Your cost of goods available for sale does not change. And for weighted average over the total number of units available for sale, which was 2,100. Right, 1,000 plus 1,100 is 2,100. Right, and that would give you an average of 2,151 per unit, which would give you an ending inventory at the end of January, because we're seeing at the end of January we've had 800 units remaining. Right, if we're saying at the end of January 800 units remaining, That's 800 by 2151, which gives us 17208 ending inventory. So I hope you can appreciate with all of these how your ending inventory is now adjusted with using each of these different inventory costing methods. All right. Um, Good. Are we good so far? Just take your time, go through with me. When we finish the lecture, you look at the lecture again, you look at your slides again. It's simple. Just take your time through it. I know because some of this information is pretty new to most of. This is very confusing, I must say, Jahil. It's not confusing. Just take your time and look it through, and we'll discuss it again next week when we're doing the review. All right. It's simple maths. I want to emphasize again, it's simple maths. If you just look, it's just wording. It's just wording at times might be a little confusing, but it's simple maths. All right. So you comparing inventory costing methods, and you would see it would now produce different results for the cost of goods sold, and then consequently your gross profit, your net income, and your ending merchandise inventory. And all of these now would now affect your income statement and your balance sheet to an extent, which would determine um, which will be determined by if it is you are using financial accounting versus tax accounting. All right. So these inventory costing methods, together with your depreciation expense calculations, can now assist your accountant and your accounting team in determining if they are going to be doing financial accounts versus tax accounts. And that's the take home I want you all to understand and appreciate, that these these calculations are done so that you can determine and have good figures if you are going to do your tax accounting and if you're going to do your financial accounting for the banks. All right. So please note that if your prices remain the same, all three methods would yield the same results. However, the reality is prices change, and we're going to go on to another one here where we'll see later on where it's valuation at lower cost of market. We'll get to that just now. All right. So the FIFO method reports a higher gross profit and a net income and than LIFO during periods of inflation or when the prices are increasing. And when there are rapidly rising costs, as you would see here in point number 2, slide 14, um, the you are now replacing your inventory at much larger costs. So then your profits will now become, or what we call inventory profits or illusory profits. Right? Again, LIFO offers income tax savings during periods of increasing costs because LIFO reports the lowest amount of gross profit and the lowest amount of taxable net income. Understand that's one of the take-home points I want you all to appreciate with using these inventory costing methods and also depreciation as well for calculation of tax and financials. All right, and weighted average is a compromise between both LIFO and FIFO, and it's an average cost. Now, the valuation at lower cost or market would be the rare occasions where you would purchase an item and some months after the cost of that item now decreases, and you'd see those examples of those would be. Can anyone think of an example where an item is bought today, and 2 months after, the cost of that item is now two-thirds of how much you paid um, today for it? Can anyone think of an example? What's a category? Cell phones, correct. I was now about to say exactly. Cell phones, electronics. So electronics. Thank you, Samantha C. Electronics. Electronics is one of those category of items that um, have generally have reducing costs. Generally, so USB sticks, for example, you would buy. Well, now it's a bit stable, but generally, um, you would see the cost of electronics always going down. So you have to be careful with having inventory and stock of cell phones and electronic items because you will now have to use this method called lower cost of valuation. Lower cost of market method to value the inventory, and um, you do this by calculating the direct cost of disposal. You subtract that from the estimated selling price to get your net realizable value. And sometimes that might actually be, it might even be in a negative. So lower cost of market method can be applied to the cost, the market price, and any declines to determine the inventory, the category, or the total inventory as a whole. So errors that can occur with inventory. If the physical inventory was miscounted, if the cost was incorrectly assigned to the inventory, if inventory in transit was incorrectly included or excluded from your inventory. So all of this, the accounting team is going to be looking at when they are calculating their end of year ending inventory figures. They would want to make sure the inventory that is being recorded is actually inventory on hand versus inventory that is supposed to be delivered. That's why there's a cutoff time, there's a cutoff date. All right. And inventory errors often arise from in merchandise that is in transit in year end and is sometimes incorrectly omitted or included in the inventory count. And on slide number 21, you're going to see the effect of inventory errors on the income statement. You'll be looking at the inventory error that is the beginning inventory being understated and how it can affect the cost of merchandise sold, how it can affect your gross profit, how it can affect your net income. If your beginning inventory is overstated, how it can affect all of those other parameters as well, the ending inventory, and how your ending inventory can affect your merchandise inventory and your current assets, your total assets, and your owner's equity. So these are things that your accounting team are going to look at in creating your financial reports. On slide number 23, there is the inventory turnover, which is the cost of merchandise sold over the average inventory, and your number of days of sales inventories, your average inventory over your daily cost, average daily cost of merchandise. So these things are we're not going to we're not going to look at these things for your exam. These last parts here, but I want you all to have an appreciation that inventory costing methods are used for determining the your gross profit, your net income, which would aid your accounting team in determining how well they produce your financial and your tax accounts. All right. So Jahil, I know it might seem very confusing. I want you to just go over the PowerPoint again. Look over the live, and we'll do another review next week, and hopefully things will come into place next week. But it's not complicated. It's pretty straightforward. It might seem a little confusing with the arrows, etc., but it's pretty straightforward. All right. So if we do we have any questions from anyone? Questions, queries regarding our schedule? We are going well so far. We actually just have one more core lecture, which is ratios. And when we finish ratios, we should be finished with all of the teaching, and we can do some reviews. I'll start to do some reviews of all the lectures that would have been gone by, and hopefully by then you would have completed your lit review. Lit review may happen next week. I'm expecting Dr. Marach to send that to you for next week. Um, and then we have the second. Can anyone tell me when teaching is supposed to finish for this semester? So based on the schedule, you may get your lit review to do next week, and then your second in-course may happen on the 9th. If not the 9th, maybe the 16th, but I'm hoping for the 9th, so we can get the results of those in by maybe the 23rd. So you can have your total coursework marks before 4th of December. 4th of December, teaching is supposed to end. So that would give us 1, 2, 3, 4, 5, 6, 7. All right, so it give us 7 more weeks, which is a lot of time to complete ratios, to do review of all the lectures, to do review of your lit review. No, I'm not going to do a review of the lit review. We'll do your second in course review as well. All right, so that's it for today. I know this financial component of farm admin would be a bit challenging for some. It might seem, as Jahil said, a little confusing. It will seem so because it's very new to you, but just take your time and go through the material. You have all the resources available online as well to help you understand it better. We will do a review next week again, and we'll take it from there. All right, so any questions, any queries, any further questions, queries? Take home message today: your inventory costing methods are important to help determine your financial statements, if it is you're doing financial based accounting or if you're doing tax based accounting. If you use LIFO, you're using LIFO to help to adjust your gross profit figure, your net income figure, which would then determine how much taxes you pay. If you use FIFO, if you use weighted average, all of these things affect those elements on your balance sheet and your income statement. That's the take-home message today, that inventory costing methods affect certain elements of your balance sheet and your income statement that will now help your accountants determine your tax accounting or your financial accounting methods that they're going to present to you for approval. Okay? And also in that as well is depreciation expense. How is depreciation expense calculated? That will also affect your income statement. That will also affect your balance sheet. All right? Good. So if there are no other questions and no other queries, we'll end today's session. You all could still feel free to send me questions via WhatsApp, and also I will try to. I've given some feedback on the second in course for community pharmacy management so far. Where I can, I will. It is time consuming to read through all of your essay questions and give fair marks for everyone. So bear with me. I'm almost through with the community exam, and I'll get started on institutional as well. So I'll see you all tomorrow. Most of you, I'll see you all tomorrow. If those who are not seen tomorrow, I'll see you all next week. All right? Take care. Have a good day. So long.